Hello, welcome to another knowledge sharing series by Europe India Corporate Finance Forum. When we speak about overseas investment and FDI, one thing that is more important than the return on investment is repatriation strategy. And today we are going to talk about fund repatriation strategies with Ms. Nidhi Maheshwari. Hi Nidhi.
Hi Vaishali. Thank you so much for having me.
Pleasure is all ours. So, Ms. Maheshwari is a chartered accountant and a tax partner at BSR Co. And with over 2 decades of experience in advising companies on corporate tax, exit and entry strategies, inbound and outbound investment structuring, she has extensively worked with European companies. So, to start with, what are some of the fund repatriation strategies that currently exist?
Sure, thanks Vaishali. So you're absolutely right that anytime anyone invests in a particular investment country, how do you get the money back, return on your investment or return of the capital itself is a very, very important driver. A very, very classic way of distributing profits is by way of dividends. It's one of the most tried and tested methodologies. The way it worked in India was a bit different than most of the other parts of the world. Traditionally, India had like a dividend distribution tax on the dividends which an Indian company paid. So take a Dutch investor with an Indian subsidiary. If the Indian company had to repatriate profits by way of dividends, so a couple of years ago, the regime was such that there was a dividend distribution tax of close to 22%. And mind you, these dividends are already post-tax profits. So this was kind of like a huge burden already on the company from a tax cost standpoint. 2 years ago, this law changed and this was aligned with the international best practices and India shifted to a classic dividend withholding tax regime. So what that means is simply that when you pay a dividend, so the same example, the Indian company is declaring profits and dividends to its Dutch shareholder, then it no longer has to apply a dividend distribution tax. Instead, it will withhold a withholding tax like you do for most of the foreign payments at the prescribed rate. Now that rate under the Indian domestic law is again 20% plus, but under a lot of tax treaties, and if I talk about European countries, it would by and large be mostly 10%, with some exceptions being in the range of 15%, like Belgium, or by virtue of a specified most favored nations clause, it can get reduced to 5%. And there are some specifics around that which we can talk about a little later, Vaishali. But there are other ways of, I wouldn't call it as cash repatriation itself, but more of ways of distributing funds or earning fees from an Indian setup that you have, which are by way of royalties, technical services fees, etc. And there also, there have been some significant tax changes.
So maybe if we can just go a little bit in detail that what was firstly about the dividend tax, and then probably we can go to the royalty regime as well, that what was the dividend regime earlier, what is it now, and how it has changed?
Yes, sure, Vaishali. So like I was saying, the India moved to a classic dividend withholding tax regime from the earlier dividend distribution tax regime. Now, this is the point of sort of a big tax controversy that we are staring at present, which is to say that whether the 5% benefit from the most favored nations clause can be imported into the treaties or not. And this will, by the way, be relevant to a few countries such as France, Netherlands, Switzerland, or Sweden, where these treaties have a most favored nation clause into it. So let me explain the controversy a little bit. A most favored nation clause is basically to say that when an Indian treaty, with another OECD member country is negotiated, which is at a better term than, let's say, the existing treaty, say between India and Netherlands. So they put a clause to say that, okay, you can avail of the benefit from the time when that subsequent treaty has got negotiated. Considering that, a lot of treaties put such clause. Now, there are certain treaties which say that while that most favored nation clause is there, but for, let's say, India to give benefit for it, India will have to specifically come out with a notification, and only then can you get a benefit, and therefore meaning that it is not automatic in application. However, when it comes to the dividend tax that we are just talking about, the treaties under Netherlands, France, etc., they do not have such specified requirement of India having to enter into a specific notification. And hence a logical interpretation, which a lot of taxpayers have been adopting, is to say that 5% benefit is available because India entered into treaties with Slovenia, Lithuania, etc., which have a beneficial 5% rate. Now the controversy is that these countries became OECD members much later. So the India treaty was already signed with them, but they became an OECD member much later, say in 2005 or something. And that's where the Indian tax department's stand is to say that, look, because you were not an OECD member at the time, so therefore that benefit should not be imported here, because it is meant to apply only on those treaties which member countries were always an OECD member country. And that is essentially, the point of debate and litigation. So this matter was, challenged and put forth before the Delhi High Court, and we had some favorable cases in the case of Nestle, etc. And the Delhi High Court gave a ruling in favor of the taxpayer to say that India does not need any specific protocol, etc. They ruled in favor of the taxpayer. Now, post that, what happened? The Indian revenue authorities came out with a circular to say that this will not be an automatic application and the 5% benefit is not meant to be extended in these specific cases. And that's because of the difference of the interpretation that the revenue authorities have. Just to share a perspective with you, these circulars are not binding on taxpayers. These are basically meant for the internal, like an internal instruction for the tax department. So what this leads to is that the technical position as a taxpayer, you can still continue to do the 5% beneficial position. However, the revenue authorities are unlikely to give you that benefit definitely at the first level of field audit or your regular, CPC scrutiny, etc. And this matter has now reached up to the Indian Supreme Court. After the favorable Delhi High Court, this was appealed against by the revenue authorities. It has been heard in March earlier this year. Both sides of the revenue and the taxpayers' councils appeared. The hearings continued for a period of few days, extensive hearings, and lots of arguments on both sides, which have been put forth. So now what we are really awaiting with a lot of anxiety is to see what the final verdict of the Supreme Court is going to be, because this is really going to be a defining point for this matter. I would say that there are strong arguments on both sides. As professionals, we technically would like to believe that there is a good position for the taxpayers to actually avail of the 5% benefit based on the way the treaty has been worded. But of course, given that this matter has reached the Supreme Court, so we are all waiting to see what the final outcome is. It's expected hopefully within this month.
What I feel is, I think at the end of the day, once the verdict also comes, a finance bill can actually put everything into perspective, and probably it should have come way before then all this litigation.
What you raise is a very, very interesting point, Vaishali, and this is something which a lot of investors, non-resident community that we deal with, they talk about it. But at least, and I know India has not had a very good reputation on the changes every year that we have the budget coming up. But at least the Indian government has made a resolve, has gone out in public, and has also lived up to its promise by and large to say that we will not make retrospective amendments every now and then. So at least to that extent, as a principle, I just wanted to address that point. The other thing is, what we are talking about right now is a very, very specific tax treaty interpretation. No, unilateral amendment into the Indian tax law can sort of change this. This is essentially an interpretation, and I think the Supreme Court will hopefully settle the controversy. There is an unlikely outcome which can be achieved from an Indian Finance Act on this front, because it's not so much about the Indian domestic provision. That rate is actually 20%, it's there. But this is about how we interpret the tax treaty.
Thank you for that.